One to Daily Bread with Tom Hartman. Today is your daily threads for your daily bread. Just working on a new catchphrase there, trying to see if it can work. Doesn't feel right. Doesn't feel quite right. All right, today we start off with President Z and Donald Trump, a meeting. This is the long-awaited meeting for October 30th. Waiting to see what's going to go on with tariffs, waiting to see what will happen with the two global superpowers. Will they fight? Will they cause markets to tank? Or will their agreement cause markets to soar? Here's just a short statement from President Z earlier today.
Trump, it is a great pleasure for me as well to meet you. And it feels very warm seeing you again because it's been many years. Since your re-election, we have spoken on the phone 3 times, exchanged several letters, and stayed in close contact. And our joint guidance, China-US relations have remained stable on the whole. Given our different national conditions, we do not always see eye to eye with each other. And it is normal for the 2 leading economies of the world to have frictions now and then. In the face of winds, waves, and challenges, you and I, at the helm of China-US relations, should stay the right course and ensure the steady sailing forward of the giant ship of China-US relations. I always believe that China's development goes hand in hand with your vision to make America great again. Our 2 countries are fully able to help each other succeed and prosper together. Over the years, I have stated in public many times that China and the United States should be partners and friends. This is what history has taught us and what reality demands. A few days ago, in the latest round of consultation...
All right, well, you get the idea. Very friendly. President Z is coming at Donald Trump, as you might imagine, with respect, something that Donald Trump will respond to pretty nicely. In fact, there was a break-in information from Kobayashi letter who was saying that President Trump announced China tariff reductions after amazing meeting with President Xi, including one reducing fentanyl tariffs to 10%, effective immediately. Overall tariffs on China reduced from 57% to 47%. China to discuss chip restrictions with NVIDIA. No more obstacles on rare earths. China and U.S. to collaborate on Ukraine for a peace deal. So a trade deal appears to be imminent. When asked, I believe, Donald Trump said that the meeting was a 12 on 10, a great success. Excellent. Markets, of course, still sold off today. We had, what kind of drop do we have on NASDAQ today? From a peak to trough from 2 days ago, we're now down, we were down about 2%. So sell the news maybe after the FOMC meeting, and this is no longer a catalyst. People can sell the news. All right, moving on. So the government shutdown is still going on. It's still happening. Some people don't know this, that the U.S. government has essentially shut down. And the shutdown induced TGA buildup and the RRP, this is the reverse repo spikes, tighten funding, elevated SOFR and SRF usage, highlight strains. These are the futures for the Fed funding rates. And what we have here is that the Treasury General Account, this is important. So there's different sources or pools of liquidity that that exist throughout the United States and the world. And one that we have a lot of transparency in is the TGA. So from a London Crypto Club, there was a post that I thought was particularly interesting. So he says, take a look at the Treasury General Account below. I don't know if it's he, they say, take a look at the Treasury General Account below. With the government shut down, the TGA is not getting spent, so it's building up as receipts are received and debt issued. So that's over here. That is the line going from the bottom here to the top right. It is starting to build up as the cash is coming in from bonds being sold and taxes. The latest opening balance stands at $965 billion, a build of circa $150 billion in October. That's cash coming out of the market. On top of that, into month end, the RRP is building as banks window dresses balance sheets. Window dressing being what financial institutions and companies might do at the end of a month or a quarter in order to make their books look better than it is. Buy and sell different assets, holding some assets on their balance sheet to be like, hey, we were part of this thing. Also, it could cause outsiders to behave in a certain way to buy a certain thing or sell a certain thing if it looks like they think the company this whole time has been had this outlook on this particular asset. Anyways, window dressing. So the RRP is up circa 20 billion so far this week. That's all liquidity being taken out of this market. Add to that, this is the crypto market that they're talking about. So all that money floating around, the tens of billions of dollars is not being flowed into the crypto market. Add to that the fact that bank reserves have fallen into the lower range of ample, which causes banks to sell us to offer less credit. This is creating some tightness in the bank funding markets, witnessed by elevated SOFR spreads and rising usage of the Fed's standing repo facility, the SRF. Yesterday, eligible firms took just over 10 billion on loans from the SRF, a record since its introduction in 2021. We talked about the SRF, I believe, yesterday or the day before, which is just a funding mechanism for approved financial institutions where they're able to borrow money from the Fed. These are emergency liquidity that's being provided for any number of reasons, but what we saw recently is that there's almost like this permanent borrowing that's happening, which means there is funding stress, as opposed to the repo markets where they'd be lending in order to get a guaranteed rate on the overnight. While it's not extreme stress, it's tightening. This is why Bitcoin, given its hyper sensitivity to liquidity, is failing to break out of this choppy range. So what changes? Obviously, after month end, the RRP will be drawn back down and return to that circa 20 billion to the market. Bank reserves will be more freely lent out too. Some tightness will remain until the end of QT on December 1st, but once that ends, we start to get the Fed balance sheet expansion once more after a few years of contraction. That's that cowbell we're looking for. That's for that printer go brr we've been waiting for. The government shutdown ending likely mid-November will also see the TGA drawn down, unleashing a flood of cash back into the market, which will see bank reserves level rise, alleviating the moderate funding stress. So the liquidity picture is set to change quite significantly over the coming weeks. This week into month end is probably as tight as US-based liquidity gets until at least year end. Towards the end of November and to the end of QT on December 1st, liquidity becomes a tailwind and we really pump. These are the levels you should be buying Bitcoin to position for the next leg higher, not financial advice, of course. Great posts. It's always nice to see someone aggregate information so that it becomes digestible for people. Look, it's a narrative. It's something that's there. What we can see is that there's money on the sidelines. There's money that's not being pumped into markets. And if that ever changes, well, we can imagine it up from there. Now, the idea is that if what we're seeing now is a tightness of liquidity and Bitcoin is still in the six figures and stock markets were still making all-time highs until 10 seconds ago, then what happens when the liquidity is not tight? What kind of blow off top will we get then? Will that be 1998 to 2001.com? One can only hope. Continuing on, next story is, I thought it was interesting. This is a clip that's been circulating around. Here we're seeing it from X Market News on X, who is, it's a clip of Donald Trump talking about potentially banning short selling. It's a small little clip, a little bit hard to hear, but see if you can take a gander.
You know, in the old days, when you announced good news, the stock market went up.
In the old days, when you announced good news, the stock market went up.
Announce good news, the stock market would go up. Now when you announce good news, the stock market goes down because
now the stock market goes down when you announce.
That's terrible. You're doing well, that's terrible. Interest rates will go up. So they think because.
And when it's bad news, Wall Street thinks, oh, it's terrible. Interest rates will get cut, and so the stock market goes up on that liquidity hope.
Because of that, interest rates will go up because that it's inverse of what it should be. We're going to go back to the way it used to be. When we announce good news, the stock markets are going to go up.
We're going to go back to the way that it used to be. When we announce good news, the stock market will go up. Interesting. Two things I didn't expect to hear there. One, obviously he's reading off a teleprompter, but one, I didn't necessarily realize that it would be in the realm of Donald Trump that he'd ever be talking about this idea of this inverse relationship, that the stock market goes up on bad news and down on good news, that he would ever say that. And two, that he would want that to change. You'd imagine that if you have the mechanism to cause the stock market to go up and down, you would just use that. But he wants the stock market to go up while he's doing good things, which is interesting, right? He wants the visibility of doing good things and the reward for it in the stock market. And so, what will he do in order to get that to happen? Who knows how far they're willing to go? But this ex poster is suggesting that maybe a ban short selling, which would be interesting. And finally, there's this interview from Joseph Wang with Jack Farley. It's a nice little clip. You should go take a look at the full video, but let's hear what he has to say here.
I think you said the Federal Reserve is going to start expanding its balance sheet.
My guess is that they will have to. Otherwise, they'll lose control over the repo market, and they don't want that to happen. I think what they misunderstand is that repo rates rise not because reserves are scarce, but because you have a tremendous fiscal deficit that's financed in repo. And without paying attention to the demand side of that, you are going to be misled and end up in a situation where repo rates do once again spike like they did in 2019, where you have to just keep adding. Otherwise, you'll lose control over short-term interest rates. It is absolutely essential for a central bank to be able to control short-term interest rates.
Again, reverse repo coming back into the markets. We had a little scare of that in 2019 that caused the Fed pivot, but Powell has already pivoted. So what will they do now if there's a liquidity problem there? We know that the Fed wants to keep volatility down. That's the whole point for that. And they want to be able to use their interest rate tool in order to manage monetary policy. And for that, they need to be able to modify the short end of the curve. They can't modify the long end of the curve. 10 years out and more, 10, 20, 30-year bonds, they can't modify that directly. What they can do is change the requirements now, the SLR, the bank reserves, the requirements, and the amount of interest paid on certain assets, either borrowed or lent. And so if they can transmit that, their level of interest rate by creating floors and ceilings in the way that they're expecting, well, then they can't pin the short end of the curve at the interest rate that they're looking for to then modify long dated bonds. And that could have a cascading effect in the very funded mechanism, the bond market that the government uses in order to finance the fiscal side, which is what Joseph Wang is saying. That if they don't pay attention to what's going on the fiscal side, they might have what the French call méchant surprise, a horrible surprise. Well, that's it for Daily Bread for October 30th, 2025. I will be back next Monday for another delivery of sweet, juicy daily threads. Nope, that's not going to be the quote. We're never going to say that again. Thanks, guys. Talk to you later.